Welcome to the SeizeYourBusiness.com podcast. My name is Kevin O'Flaherty from O'Flaherty Law, and I'm excited today to announce that Jim Wozek from Success Enhancement is co-hosting with me from here on out.
Pleasure to be here. Thank you for inviting me.
Yeah, before we get into our guest, Ed Garner from First Midwest Bank, Jim, why don't you talk a little bit about yourself and introduce yourself?
Sure. Well, Jim Wozek, Success Enhancement. I help people be more successful in a variety of ways. One of the things I've most recently been working with is using improv-style comedy to improve business performance. So we do workshops that teach people some improv techniques, which makes them more comfortable and more spontaneous, as well as relationship building programs where we teach some improv to a client, their suppliers, key business contacts, etc. And I also love sharing my network with people. So, anytime somebody needs a resource, I usually have somebody for them. So thank you, Kevin.
All right. Well, welcome, Jim. I'm excited to do this with you. Our guest is Ed Garner from First Midwest Bank.
Thanks for having me.
And our topic today is going to be, Ed's going to talk about the banking environment for small to mid-sized businesses. So, Ed, why don't you take it away and talk a little bit about yourself and what you do and your experience.
Sure. Thank you. I've been in the commercial and small business banking environment now for 25 years. Actually started in banking, put myself through college as a banker, working downtown, and moved into various roles within the banking industry. I've done everything from personal banking to commercial banking, including asset-based lending. I've spent considerable amount of time in real estate lending. I think I've lent on just about every real estate asset class you can lend on. And I actually spent some time out of banking working on a national basis in the real estate arena, and have found myself migrating back to what has always been my first love, which is working with the lower middle market companies. To me, the widget makers and the service providers down at that level, I get the most satisfaction, I would say, personally and career-wise, working with those type of companies. And be it newer companies to multi-generational, I try and use the experiences that I've garnered, if I can use my own name, over the last 25 years to help guide them, from A to B. And it doesn't really matter where their business is in their life cycle. I've probably seen it. I've spent some time on the workout side, so I've seen them at their worst and at their very best. And I think the idea is to, again, like you mentioned, Jim, to use the skill set that I have, and not just the skill set, but the broad base of business contacts I have to help them, in their current state and where they want to be in the next 3 to 5 years.
Yeah, that's good. Ed, you mentioned workout, and I think that's something that we all could use a little more help with.
The camera doesn't pan down, does it?
No, thank goodness. But I think there's some people that may not totally understand what that term means. I know you bankers all do, but why don't you just give them a brief description?
Well, and not to dwell on anything too negative or anything, because a lot of times a skill set that would quote unquote work in a workout situation is more to help companies that obviously, as we went through the Great Recession, I mean, nobody accounted on 40% drops in revenues, no matter what industry you're in. And what are the steps you take to be proactive to quell any of the losses that may come from that that type of marketplace? So for me, I really concentrated on what can we do with an existing company to save it, and maybe restructure a balance sheet, et cetera, versus when you think of workout, the true last case is where you've parted the relationship with the bank, and perhaps you've even gone as far as liquidating. My experience in terms of workout was working with those clients that still had, a very workable business model, but what behavioral changes, what structural changes can we make that would, maybe not ensure recovery, but certainly would aid along those ways and put some best practices in place that might help that company succeed.
So you actually work with companies to kind of consult and restructure their business model?
Well, you want to be, in my opinion, as a business lender, you want to be a trusted advisor. Obviously, I'm also a lender, so I want to be very careful about how I do that advising. But yeah, I mean, you want to make sure you understand the client's business model such that you can understand their cash flow cycles, their capital expenditure needs, et cetera. So you can incorporate that into what products, what structures of those products that the bank can provide them so they can be successful. So it's within the concept of what I'm bringing to them as a banker and a lender. So I don't know if the answer is to tweak their model as much as it is to understand it and then suggest ways that I can help them as they move from A to B.
So you're not telling them you need to fire this key executive because he's making too much money. You're telling them, hey, we have this particular loan package that might be able to work you out of this problem.
But you will have a discussion on the current cost structure, sure, of a company, and you want to bring that to the forefront for a company. I would be loath to suggest that somebody, necessarily fire a key executive. Those are hard. Those are hard to come by, and you obviously there's a difference between cutting fat and muscle. So from my perspective, it's more having those open discussions, however, about where you might be in your business cycle and comparing it to where your balance sheet might be today, or where your fixed costs and variable costs might be in that cycle, and then how do we address it? So it's a little bit more 10,000 foot than naming particular employees or anything like that.
So Ed, in my experience, I think having the right lender, the right bank can really help a company achieve its goals. Is there any particular success story where you've worked with somebody and helped them really move forward?
Yeah, there's a few that come to mind for sure. One was a multi-generational company that was under some stress with their existing lender. I was able to go in, look at their current balance sheet situation, and notice that the way they had structured their debt, the original bank actually didn't do them a lot of favors considering the cash flow they had available to them. And at times, depending on where you're at in the cycle, a bank can what they call the old lender fatigue. And depending on the resources available to that particular bank, they may not have been able to spend the time. I think with my experience, it allows me to maybe be a little bit quicker in that assessment. And in this particular case, I was able to look at the balance sheet, restructure some of the debt such that we were able to work up a portion of their working capital line into a more term debt situation. But by opening up the credit line for them, they were able to obtain some business insurance that they needed from a bonding standpoint that allowed them to take on a couple of very lucrative opportunities, thus kind of catapulting them into a better position. So literally within a year's time, their balance sheet looked a little bit better. They were able to obtain some new business relationships that continued from a revenue standpoint at nice margins for them. And because of that, we were able to take down the liability side of their balance sheet, but also get them the working capital that they needed to sustain the growth. And from that point on, it's been going well. That's one particular thing.
I got a question. Be careful at this table because we have state of the art equipment here, and we don't want to set up like a harmonic vibration or something. But that's okay. You don't know.
Thank you.
So here's something I'd like to have you comment on. I've heard some people say, banks want to lend money to people that don't need money. And while that's kind of a humorous thing, I think what a lot of people don't understand is that banks are not sources of venture capital. They're really sources of liquidity.
Well, thank you. Thank you for pointing that out. I think that, that's a great leading question to kind of what the current environment is. And again, this is my opinion. Although I work at First Midwest Bank, this is a little bit more global than just my opinion and what I'm seeing in the marketplace. There is a definite want to lend on the banking side of things. On the other side, there's a much more scrutiny and much more oversight. Oftentimes, some things that were already in place, but now are just being done on a more formal and thorough basis when you're looking at audits, be it the bank's own auditors or the FDIC, et cetera. So because of that, the reporting requirements and the capital requirements that are thrust upon the banking industry kind of throw some more hurdles out there for the businesses out there. So you're right. We're certainly not a venture capital fund. We are a tool for the business to obtain the funding that they may need to help with their growth. But we're certainly not it's hard to just be a pure equity play, and the banks certainly aren't structured to do that.
So let's talk about our topic a little bit. And what is the current banking environment for small business and medium-sized business? We've touched on some things already.
Yeah, well, in to that regard, I would state that again, there's definitely a willingness to lend, and the banks that are out there today that have thrived and survived are definitely looking to grow their portfolio from an organic standpoint. I would state, however, though, that the reporting requirements, the capital that we talked about before, do put in some challenges to that regard, especially as you look at the lower middle market and maybe even the small business more importantly. One of the things that I've always found challenging working with small businesses, because they have their own challenges, meaning from a manpower perspective, et cetera, you often have to wear many hats in those businesses. And we are an information-driven business. We still look back historically as an industry as much as we do going forward. But no matter whether we're putting an emphasis on historical information versus the business plan going forward, it all dwells down to that information. And the small businesses oftentimes don't have the manpower to produce those detailed reports, financials that maybe you got once a year from a client. You're now looking for that reporting quarterly. The clients you might have been looking at stuff from a quarterly basis, you're now wanting that information monthly. That means that the lower middle market businesses have to have the manpower to produce that reporting. There's potentially one bright side to all of that. In my 25 years, I think I've always been an advocate for my clients to really understand their financial statements. It's something that I've always impressed upon them to make sure they're looking at on a regular basis. So as important as it is to deliver that widget, at the end of the day, it's as important, in my opinion, to understand if you delivered it profitably or not, and what your opportunities are going to be going forward. And then how do you then go to the market, be it a bank, be it an equity source or any other funding type, to obtain the funds that you need for that. I mean, I think we've all can agree that the amount of funding sources out there are as many as there ever have been, especially when you look at online funding sources, et cetera. But they all bring with them a certain amount of challenges or offsets. They can be very expensive. They can, so in those cases, maybe online's easy to use in terms of the timing of it all, but you also then may give up a lot of your margin potentially, depending on what the need is for your financing, versus a bank, which is obviously the much more traditional tools to use for that financing.
Okay.
So Ed, here's a question. So let's say there's a Mr. Entrepreneur, invents a brand new, let's say a watermelon slicer or something like that, and he's got the product developed and the business kind of takes off. He's funded it through, friends and family or maybe credit cards or something. And now he's got enough critical mass that he thinks, he can go to a bank for some traditional working capital. Now he's never done this before. What would be some of the steps you'd recommend? I mean, does he hire a loan broker? Does he read a book? Does he just start doing it? What would be sort of your recommendations?
Well, I would hope, and here's where I find the relationships that we've developed over the years become very important. You would hope at the start of a startup. So in your example, let's assume for sake of argument, he's into it a couple of years. Mm-hmm. But, at that onset, who has he surrounded himself or she has surrounded themselves with at the onset? To me, having, a great CPA and a great business attorney, not to just, but it's honestly true. Yeah.
Kevin, you know any of those you might want to recommend?
But it is true. So who do and I would even say, do you have an entrepreneur already in your corner? Somebody who's been down the road that can help you guide your startup in the very early stages. So now when you're coming to the bank for a loan request, what's I think very important is the information at hand. Okay, so what I had stated before is, just walking in with a personal tax return and financial statement with the business's 2 years tax returns just isn't enough anymore. The bank, depending on what the request is going to want to delve into, how does the company look on its interim financial statements? How's the company's business cash cycle look? So we're going to dig into your AR. We're going to measure that against your AP as well. Are the vendors getting paid? Is there margin in this business? Can the business be profitable? Then on top of that, why are you coming to me? What is the opportunity that you see that requires further funding? If you're looking to, pay out friends and family who helped you start after the first couple of years, my guess is that's going to be much harder to do. But if you're looking for perhaps equipment financing, or you're looking for a working capital line of credit that would help grow that opportunity because of what you've already seen in the past 2 years, that's much more obtainable.
So there still is some subjective judgment that you as the banker get to make about the quality of the person and the quality of the business and what their goals are?
There, without a doubt, and that's why as much as the reporting requirements on the bank are much more so these days, to the point where, and if I might venture off a little bit, I think that's why you see the consolidation that occurs in the banking and has occurred. Candidly, I hate to admit this, but I've been wrong. I actually thought that would increase and go off at a bit faster pace than it has. But a lot of that stems from the cost that the banks have to do in terms of hiring backroom people to help continually assess the risk of their portfolio. So as much of that is going on, you still have to look at these opportunities on a case-by-case basis, because there may be some merits there that one opportunity doesn't have versus another.
Is there still like a bottom line threshold that, no matter how great you think this business is, if they don't meet X, Y, and Z requirements, you're just straight up not allowed to give them a loan, and they're not going to get a loan no matter what? For example, when I was starting my firm, if I hadn't been in business for 2 years,
right,
I could be the most powerful, profitable attorney on the news all the time, and I wasn't getting a loan anywhere without, a couple years worth of business tax return.
Yeah, and I would say, those are still some of the basic hurdles that you have. I mean, we do like to see a company be in business for a couple of years. Ideally, you'd like to show that you're rolling into some profitability. Obviously, there are startup restraints or constraints to a young company where cost outlays are more or maybe one time in the startup that you don't see on a regular basis going forward. But even with that, you want to show that the company, that your business model can be profitable. Otherwise, you almost have to ask yourself then too, why am I doing this if I can't create a vehicle, a profitable vehicle. But having said that, it's very important. That's why I go back to who have you brought in as your original team. I think most CPAs, certainly the ones that I've worked with over the years, understand how to help a young company. And because the bank structure is generally one of your cheaper sources of financing, and when I say that versus, friends and family can be very cheap, but if you have to go to, truly an angel investor or a private equity fund or something along those lines, that can be a very costly method of finance. It serves its purpose for sure, but generally a bank is your more kind of cheaper source of financing. But obviously, to get there, you have to have some capability to show that the bank can lend into it safely, because we are not, as we stated before, a source of equity. So the balance sheet, how you treat the balance sheet is very important, and that's why in startups it's very hard to, and I wouldn't even say just startups, just young companies or those smaller to lower middle market companies, where say you have a successful year, it's very tempting to take all of that and say, well, I put all this blood, sweat, and tears in, so I deserve to take this profit out of the company. You do, but as you do that, just remember that then that makes it harder to get the cheaper financing in the sense of a traditional bank loan, because you've kind of decimated the balance sheet while doing that. Okay, so there are those things, and a good CPA will help guide you in that regard to kind of, how do I build this so I do become quote unquote bankable. And if I just might add to your point, there are still other tools out there that can help a young company if a bank can't do it. We have the tool. Other banks have the tool as well in terms of SBA 7A financing. That's often a good tool for a young company to obtain the financing at maybe where they might be collaterally light, or they might need some non-traditional amortization terms to help from a cash flow standpoint. Mm-hmm. So there are other options out there that it still gets you into a bank, and then you work with your banker and your other advisors to get yourself to a point where you are then truly bankable, and you want to get maybe out of some of those structures. Like
so I have this question actually in a way is for both of you, but a bank is going to want a loan agreement, and they may want guarantees, covenants, etc. Kevin, what would be some of the things you might caution a client about when getting into a loan agreement? And Ed, what are some of the reasons you guys are asking for those things?
Well, those are the types of agreements that if you're gonna sign one of those with the bank, there's not a lot of, it's not really a two-way street in my experience. That's not really a situation where you often have an attorney negotiate the agreement, at least in my experience. Mm-hmm. It's basically, if you want this money that you need, here's what you got to do. And going with a bank, it's usually not too onerous. You want to know what interest rate you're going to be paying. You want to know, when you would be in default, so you don't end up losing that line of credit and having them come after your business. Almost certainly, if you're a young business, you're going to have to sign a personal guarantee, and there's no two ways about that. But I don't see a lot of situations where clients come to me with a loan agreement and say, "Hey, can you review this?" Because usually it's it is what it is. Is that your experience too?
It is. Listen, at the end of the day, the bank is still lending money. And for that, they're going to put certain safety measures in place that will help with the repayment of those loans. So, are there? Sure, there are absolutely companies out there that have weathered storms and such, and then gone through the successful times. That, back on what I stated before, have created balance sheets that really help the company stand alone, and can make that argument that I don't have to put my personal guarantee to this because I've been conservative enough in my building of this company that the assets and the business model itself stand alone for its financing needs. So it exists. I would say, certainly coming out of this Great Recession, the recovery on the revenue side has occurred for a lot of industries, and you've seen some balance sheet recovery come, but there's still, especially in the lower middle market, collateral values haven't come back. We haven't seen real estate come back. So most of your assets, equipment, et cetera, there's still plenty of that out in the marketplace. So you haven't seen those collateral values return. Mm-hmm. And that is generally the assets that you say, well, look, I've paid for cash for these. I've done this. I've done that. I create very little bit on the liability side, and I want to lend against those assets. Well, they only create so much value for you to borrow against, and they could vary from industry to type of collateral, et cetera. But having said that, they're generally oftentimes not enough to just support the company on its own. And not that you would ever underwrite another 40% reduction mm-hmm. in the economy, but having said that, very few companies can especially in the markets that I think we're addressing here today, which is that lower middle market and the small business, sustain themselves from a balance sheet standpoint when there are even mild or too disruptive downturns in their revenue cycle that quickly can erode the equity portion of their balance sheet. That is why, at the end of the day, oftentimes you are asked to support the company. This is your company that you've started out, and I will often look at companies that will ask that and say, well, I would turn around and say, well, what is it about your company that wouldn't want you to sign for it personally? Mm-hmm. And I get from a from an estate planning standpoint or any of those reasons why they would want to remove themselves from a guarantee. However, I think once you show, and you can even probably go back historically and show them how, the economic up and downs has affected their company, they generally understand why that support is needed. And you want to know if there is another dip that, especially in those cases where we talked about very early on here, where they were successful and they did kind of take out of it, and that's fine as well. But when you do that as well, then I need you there, because at some point, if collateral values go down as we suggested, or your revenue side goes down and you have less receivables for me to lend against, et cetera, I'm going to look to you then to say, well, we need you to support this company. If we're back on that recovery path, we need you to provide some of it, because my hands are tied from a banking perspective as to how much I can lend against a piece of machinery, how much I can lend against your real estate, how much working capital I can provide you. Going to 100%, it's just not wise, and most people don't do that. In my 25 years, it's funny that this topic, and when you get into these kind of discussions and forums, this topic does come up, but really in 25 years, I've had very few conversations with the companies I've worked with in terms of, I don't want to personally guarantee this. Whether it's just, as you said, it's just kind of what the market expects or not. I think most business owners are willing to put their name to their company because they do believe in it that much.
How does the Fed's recent rate increase and the expected rate increase, how does that affect your industry, if at all?
When you say that, I'm always curious to see, like, when do you think the next one's coming?
That's true. We've been saying it was going to happen for about 3 years before it actually happened. So,
well, it's very interesting, because I don't think that this particular cycle matches any cycle in the 25 years that I've been in the banking or lending industry. So, obviously, as the interest rate environment rises, that can increase the borrowing costs for companies. It can also make deposits at banks look more attractive for the banks. So those are two very high level things that can happen when the rate environment changes.
Does it loosen up lending in order, if the banks are getting higher interest rates, does that allow them to take more chances on risks they wouldn't otherwise be taking?
Well, and here's why I say it's maybe a little bit different than in other cycles, and it's something we touched on before. It's a different environment now for the banks in terms of your capital requirements and the monitoring of your portfolio. So I'm not sure that a quarter point here, or in a even rising interest environment, let's say for sake of argument, there weren't all these global concerns, and the economy was taking off, and Europe was doing well, et cetera, and our environment, interest rate environment, continued to grow. That would change the analysis that the banks are now doing with their business clients. And once you do that, it kind of pulls in the Wild West days that probably used to occur, when the recoveries of the recessions were much steeper. So I think, and maybe that's the whole point, trying to tie it back around, is that for the foreseeable future, whether we're going to continue to have interest rate rises and the Fed hikes it again, which I don't have a crystal ball, but when you see what's going on out there, even just from the U.S.'s perspective, but more importantly globally, I find it hard to believe that it's going to be a very active Fed in terms of interest rates, and that's my opinion. Certainly not coming from the bank standpoint, just my own personal opinion. I just don't see where the Wild West days are going to be back, because it the reporting requirements are going to be too onerous on the banks for them to. And again, the structure's already been put in place for many of the large banks. The hiring has occurred, and as long as you have those reporting requirements, you're going to put those people to work. And when you have that type of support, you have the ability to dig in a little bit more. Again, maybe I'm a bit naive, but I think it's really an opportunity for the banks and the lenders out there, such as myself, to really understand their clients more, because you're going to see their information more often than you probably did before. And I would hope that because it's being requested a little bit more, that the business owners themselves are paying attention to it a little bit more. So there's Ed the optimist, thinking that maybe this could be ultimately beneficial for everybody. However, we're all slaves to the general economy. So
no, there's something you don't see every day, an optimistic banker.
Yeah,
I love that. I want to get back to something you said earlier, Ed, and first I'll start with a question. Are you married, Ed?
Yes, I am married to a lovely woman, Judy.
Good.
Who, God bless her, she's known me since 7th grade, and she's still married.
Wow. Because you said before about being wrong about stuff. If you're married, I mean, you get a lot of practice being wrong.
Well, add on top of that, I have 4 kids, so I am wrong quite a bit. If I had to tally it up.
How old are your kids?
I have a 14-year-old son, and then 3 daughters, 12, 10, and 9.
Okay, good. Well spaced.
Yes. We are a travel softball family. So
beautiful.
2 of the girls in travel softball. And my son is a freshman at Lockport and wrestles on the varsity team. So I'm pretty proud of him for making that accomplishment.
That's interesting how things have changed. When I was a kid, if you wanted to play a sport, you'd go down the block, you'd get some of your buddies, you'd go play. Now these kids got everything so organized. They got schedules like Fortune 500 executives.
There are times, Jim, that I feel like rather than a family, my wife and I run a small logistics company.
Sure, absolutely. I totally get that.
Running and candidly, we you almost can't do it without the help of other parents as well.
Yeah,
but,
sure.
Well, I'm going to be over here, so I'll pick up your son and daughter, and we'll bring them this way, and you grab mine over here, and we'll meet somewhere in the middle.
Yep. Yeah, I'm sure.
And that even takes then coordinating as well. But it's fun. It's much more competitive than when I was younger. Certainly, the amount of time and expense, to be candid, that you put into this for the kid to really enjoy a sport is it's kind of mind blowing.
Yeah, my son's played hockey, so I know.
Oh, you know.
I know what that's all about.
You know exactly what that is about.
Well, thanks for sharing your wisdom with us today. If someone wants to reach out to you, how can they reach you?
Absolutely. You can reach me at my direct line at my office is 815-774-2011. And my email address is ed.garner, Garner, at firstmidwest.com. Thank you so much. I know we were kind of broad on the topic, but I think it's important, to get that message out to your clients, my clients, our prospects that we're all trying to work with, that, the banks are still out there willing to lend. Make sure you have your advisors lined up. Know your numbers, okay? Make sure you are on top of your financials, and start the process early, okay? Everything takes a little bit longer, but that doesn't mean that again, there is a willingness out there to lend. It's just a different environment, and you have to plan accordingly.
Okay, super. Well, thank you for being here, Ed. Jim, why don't you share your contact information, too, in case someone needs business coaching?
Jim Wozak, telephone number is 630-272-3895. And my email is successjw@aol.com. You can also look at the website, Improv for Business, improv-for-business.com. Thank you.
And I'm Kevin O'Flaherty, 630-324-6666. And please check out our website, seizeyourbusiness.com, where you can find a video of today's podcast. So thanks for being here, Ed. Nice
Thank
job.
you. Appreciate it.
Thank you.
Thank you.